Good morning, traders. Welcome to the Flow Show. It's Tuesday, 3rd of October. Getting through this year one way or another. Morning, Mr. K-Man. How are you?
Aloha. Yeah, I'm good. I'm good.
Good stuff. Good to hear it.
Really?
Right, lots of moves going on again. Seems that Asia wanted to have some fun and games with the dollar overnight, and that we'll get into. Nothing out of China. They're on holiday. So their feet up with the suntan lotion going on probably. Doesn't mean that officials aren't keeping their beady eyes on the screens though, but we'll have a look at dollar China in a bit as well. So firstly, for Japan and Japan's Minister for Economics and Trade, SECO, says they will mull income and corporate tax cuts, according to Kyodo. So potentially some more easing there on the fiscal front from Kishida. Suzuki was out with his usual waffle, no real uptick in rhetoric. However, he did drop in one important line, saying that currency levels won't be a factor for any judgment on whether to intervene or not. It's volatility that matters. That is two things we're missing from the intervention playbook at the moment, is volatility and dropping in comments about speculation. Now, we have been wondering, as you'll know from prior shows, as to whether the level of the yen would be a factor. It is something they've mentioned about looking at various indexes previously. We've been following a few ourselves because they have all broken below levels when they last intervened. But while they do look at it, it seems it's not part of the plans for intervention. So we can probably stop all looking at it now. So he's pretty much confirmed we're looking for volatility at the very least to make that step up to finger hovering over the intervention button. What does that mean for the yen? It's potentially a green light because if those that were looking at, well, the 150 level as a possible intervention level, that's been blown out the water. So we are, as I said, looking for volatility. That volatility is moving 200-300 pips a day, or very volatile moves, 100 pip spikes and drops in sessions, that sort of thing. And we haven't got that. Now, those guys and girls who are in our chat room and have access to the dashboard will know that there's barrier action in play, particularly for dollar yen here at 150, which I was beginning to suspect anyway, given the price action into the figure. There are barriers in other pairs, but that's for subscribers, and you'll get to know where those big barriers are and their effect on the prices of the various currencies. But there we are, dollar yen. There is a barrier at 150. We do have now, as I say, a potential green light for it to continue higher. I think if it knocks out that barrier, we probably might be heading close to 151 not long after, unless they just want to trip it up, hit some stops, and then all pile into shorts again. We can stop looking now, Kay, can't we, at all the TWIs, the nears, the rears, and everything else?
Unless they intervene and then say like the near is lower than last year. Yeah, I mean, I was actually pretty not certain. We never certain in markets, but watching those things very, very closely, because it did look like as soon as we dipped below the TWI of last year, they started to up the rhetoric. But yeah, so I think we can throw it all in the bin. That's one less indicator to watch. And we had been saying it already that the volatility was not there. And actually, if you look at it over the past sessions, we had that activity over the end of month. And I reckon, as I said last week, they upped their comments because they probably knew what was coming for yen selling end of month. But now this hump is over. We have not yet accelerated. We had of course the non-shutdown reaction in the US dollar across the board, putting dollar yen as well a bit higher, but a lot less than others. If you look at all the yen crosses are lower. So that was the intervention fear, but also I think we had various technical levels on yen crosses where it seemed to be enough for now. Bit of false breakouts in one and the other. Now starting to correct. But yeah, I mean, as far as dollar yen is concerned, there's two things we will have to watch, right? There's one, is it going to pick up speed for one, just because of speculation? And two, we are now in those 4 days, we're starting those 4 days of pretty heavy jobs, labor market data in the US. It could be that we are starting to see some weakness happen, and that will naturally curb some of this dollar strength, weigh a little bit on the yields, and everything maybe really calming down for the yen on the yen pressure, because bad numbers, bad state of the economy is usually not too bad for stuff like the yen as well. But in turn, if we start to hold and those data do not come in weaker, and then we have what do we have, the kicker on the ISM coming out as well on Wednesday, tomorrow. If all those things are holding up, then I reckon we're back on the train for a higher dollar yen, really. And then the speculators may come out of the woods and really try and go and test it, right? Because Suzuki just gave them bit of a stick to get to hit him with.
Yeah, I mean, it's definitely clear. You can see, the difference between yen pairs now, over the same period. It's a lot of it seems to be dollar that's having an effect. Euro yen was holding up, but it's not making fresh highs. It had made fresh highs, but it's not following the same since we've come into September. A lot of the other yen pairs, which were heading up in August, but now it's a bit of a different picture. Dollar yen is just on its grind now. Okay, he's come out and said they're not worried about the yen level, but if this grinds up to 160, even if it's over the course of another month or two, it's got to come to a point where the level will be an issue for them.
Oh yes, definitely. I mean, there's no doubt that if we go above the prior high, let's say above that 152 already, I think there's going to be, unless it comes with a massively big dollar elsewhere. I mean, if dollar yen is at 152, but euro dollar is trading at 102, there's probably very little they can do, really. Or if cable is trading 117, just as examples, there's very little they can do with interventions. But if it goes on its own, there's definitely going to be reactions, even on a grind. But
I suppose that's when we get the speculation comments dropping.
Yeah, that we will have to look for that line again. That is going to be the line again. If they say that they determined that the move is speculative, then usually the next hours or the day after it's bingo, right?
Yeah, exactly. And right, well, she'll keep an eye on it. I'm still long this one. I was getting a bit nervous up at 150, but now these comments are out. I'm happy to stay long, and I'm going to look to play a break of this 150 if it blows. Now there's a barrier there. It's a big fat target. The dip has been bought up pretty quickly. We did get a dip into the 60s, and that's been hoovered up. So sitting here right now, I think we've a greater chance of busting this than holding it at the moment. But we shall wait and see. You never know what happens in these markets. Right, moving on. The RBA, they gave their printers an easy job this week or this month. Pretty much a copy and paste of the last statement after keeping rates unchanged. Some further tightening the monetary policy may be required. Pause allows time to assess the impact of rate hikes. Same old from probably what I think the last 2-3 statements now. So no real change there. Bullock not looking to upset any apple carts on that one. BOE's man says she's a hawk. And on interest rate policy, not that we didn't know that already, sees more resilient domestic demand in the economy, and monetary policy only recently became restrictive. Over to those clowns at the ECB. I like this headline. Well, the first one, ECB Simca says inflation on its way down, and then says the prompt response of monetary policy was effective. Talk about over-egging the pudding. If you're having a prompt policy response, you're not hiking rates by 25 pips, then 75 pips, then 50 pips increments. You're doing it slow and steady, well in advance of the problem, not chasing your ass after it. So load of cobblers from him there. ECB's chief economist, Philip Lane, says food inflation is still a substantial issue. Services inflation is now a big contributor, and that the upward pressure on inflation from wages remains. Now, there's not many ECB bods seeing wages as a pressure, but Lane seems to think so, and I think he's probably right about that. ECB's Holtzman says that they are to discuss ending PEP reinvestments at the next Governing Council meetings. Which ones they are, we don't know. But that's coming up for discussion, it seems. Had been brushed under the carpet at recent meetings. Can be seen as a form of further tightening if they're going to increase QT and drain in the balance sheet. ECB's Välimäki, who you may not have heard of, he's standing in for the Bank of Finland, Olli Rehn, who's looking to become president or PM. So he's off on a political path. So the stand-in Välimäki says further rate hikes can't be ruled out. Whether we want to take his word for it depends on whether he gets a job or not.
He has to say something, huh? He's a replacement.
Yeah, he has to say something.
One of the most hawkish ECB members, so he had to say relatively the same thing, right? Yeah, stick to the plan. He's probably got his feet up on Olli Rehn's desk, going through his notes. Right, looking at some of the data, go back to yesterday first. We had the ISM numbers coming out. Well, the final S&P number came out better than expected by almost a whole big figure, 49.8 versus 48.9 flash, higher than last month, not quite breaking into that expansion 50 level. As you can see there, the CAD number also coming up a tiny bit worse on that one. The ISM was a decent number as well. Improvement didn't break into expansion, 49, but beating expectations, 47.7, and also much higher than last month. These were very soft landing numbers. Prices paid dropping quite a bit to 43.8. Was expected to rise 2 ticks to 48.6. Employment, look at that, moving well into expansion, which followed what we saw from the S&P PMI in the flash number, where some of the numbers were a bit gloomy underneath, but they said that employment was at the highest since May. That's been echoed in the ISM. So still, we're not potentially seeing any problems coming in the jobs market. So they're getting low inflation, more jobs. It's soft landing music for the Fed. From that, we got Fed's Bowman out saying that expects it to be appropriate to raise rates further. A bit of a repeat, one of the more hawkish on the Fed board. The frequency and scope of recent data revisions complicates the task of projecting how economies will evolve. So a bit of a moan up at the data there and what comes out in the first number and then how much it's revised by. Maybe they'll borrow Bernanke back after he's finished sorting out forecasts at the BOE. Anyway, says remains willing to support rate increases at a future meeting if the data indicates progress on inflation has stalled or is too slow to return it to 2% in a timely way. Fed's Powell was out as well. Nothing really hot from him. Says the Fed's ambition
is a sustained and strong labour market. And to get that, price stability is needed. And the Fed is very focused on achieving that. Well, as I said, those ISM numbers fall right into those categories. Fed's bar says the most important question is how long rates stay high, and he agrees with Powell that we can proceed carefully on rates. Fed's Mester, another one banging the hawkish drum, says we'll likely need one more rate hike this year because inflation remains too high. That's been it. Quiet morning this morning. We did get a few little bits and pieces out over Asia. Swiss also had CPI report. We saw CPI ticking up a little bit. Ticking up a little bit to 1.7, not as much as expected, 1.8. The Eurozone measure also ticked up, if I double check that, ticked up to 2%, I think. So getting to the top of the SNB's target there. Keep an eye on that one in case inflation is picking up there as well. Okay, anything crossing your peepers?
No, you covered most of it. On the RBA, we had the impression just before Lowe's last meeting that Bullock was preparing to be a bit more of a hawk, and then finally she decided, once she's really in the seat, to just continue with what the RBA printed in the past month. Perhaps she didn't have much time to do prepare anything herself and just said like, okay, let's do a copy paste of the prior statement. But no, so perhaps there is the slight more dovish surprise in the RBA statement that Bullock may have sounded a little bit more hawkish, but that is not what happened. In the rest, really, there's very little market moving going on. There was an article and an interview with ECB Holtzman out that apparently rates are going to be less of a present subject on the next ECB meeting, but what they do with the PEPP reinvestments are going to be more important in the next meeting. So that may be a little hint from one of the hawks saying that over the next meeting there shouldn't be we shouldn't be expecting much from the ECB apart from on the QE/QT front. So, but for the rest, it's been extremely quiet. The rest is all everybody having an opinion about how bad Sunak is doing, how Bank of England should not use QE too much anymore for the next crisis. But it's all like opinion pieces, nothing that really moves the market. I think we can start to safely look ahead at what's going to happen to the US jobs market. Yeah, very much so. So not really any move of note on the RBA in the Aussie versus the dollar. Are getting down. We did sort of just get close to the big figure, 63 down there, and that trend line low there. But as you can see, the bounce so far this morning is already evaporating. We managed to get, what was that? A whole 24 pips higher odd before we've started to pull back. Aussie Kiwi is one I'm keeping half an eye on. Again, we've got some trend line action down here. Looking at maybe playing something between the RBA. I was looking perhaps to see if they were a bit more hawkish or gave us anything more hawkish at the RBA. Because I did was eyeing for maybe a move back to 108 to sell on a potentially more hawkish RBNZ, which is tonight. And funny enough, I took that up with Mr. Michael Brown at Pepperstone on the trade-off, and that was last night. That's published, so I've just put the link for you in the chat there if you want to go and have a butcher's at that. Just a bit of a play, as I say, on Aussie Kiwi that I'm looking at. But in the meantime, we are close to this support down
106, 70, 80 area, trend line coming in there. So if nothing happens over the RBNZ, then I might look at it from this side, but we shall wait and see what happens with that one. It's pretty much the same story around a lot of pairs. You know, we've gone through the 105 now in euro dollar. The bounce, again, isn't looking too hot. We're just managing about 20, 30 pips off of that low down into the 60s. Now we need to see what happens up here. You know, we're already sort of finding a bit of resistance around these original lows that we saw, and then the secondary low yesterday before we really made the breakthrough. So a bit of traffic here, but it's, for me, it's all about that 105 again. If we get up there, hold it and stay below, then that's going to suggest we're going to see the same sort of thing we've seen all the way down. We saw it at 107, the break, hold, little nicks above, but staying below. We saw the same at 106, couldn't get back above significantly, and then another leg lower. So the pattern in play that we've seen for quite some time now, pretty much since the summer, is keep heading lower, keep heading lower. Now, at some point, it's going to stop, obviously, but you know, we're in knife catching mode, or if you're in knife catching mode, it's still a dangerous game at the moment. So yeah, this area here is going to be important. Stay below that. I might even think about nicking into shorts on this one just to see if we continue lower. But be mindful that we have come a long way yet. But like all trends, we can go much further. You know, look at the trend from September, how far that went. So again, pick your levels if you want to try catching those knives. We got the fib coming in down at the 104 handle. Keep an eye on that one. Bit of an intermediate on-off area around 104.5, just to keep an eye on that one as well. But judge your levels. One thing you should do when looking at the charts, if you've got several levels in play, rate them for their potential strength. You know, and then the ones you feel are the most strongest, those are the ones you should look to trade, particularly when you're seeing strong moves like we are now. This is also a time where the market tends to ignore the text. If it's going to be buying dollars and a lot of dollars, you don't care about your fibs and your moving averages and your this, that, and the others. If it's got dollars to buy, it's going to buy them, and buy them until it's finished buying them, wherever that may finish. Cable, a lot of eyes on this fib, and where we went through it pretty easily. I think we stopped there for about 2 hours by my account, looking at that. Just as we got down to it, so around about there. So we stopped there for a couple of hours and then we broke. But again, we've had a low, we've had a bounce. Now the levels come into play again. But the bounce still looks pretty weak, you know, 30, 40 pips at not even that. So we're now below the 121, which is a former level. All these pairs, all these dollar pairs are looking very similar. So what you can do is you can use that low as your marker now. If we get back down there, test it, it holds, well, it gives you a bit of conviction to maybe try along and try catching that knife. But you don't want to be giving it a lot of room on that, you know, 15, 20 pips stop at most. So that if it does break, you're not going to do a lot of damage. And if you get the bounces, you know where you need to start taking your profits off into 121s, and then get some money off the table, put some in the bank, leave a little bit of the position on, see what it wants to do that. And if it does break 121, well, fine, you try and ride it as much as you can. But as I say, you want to try catching those knives, do it as safe as possible. I've not really got much else. I'm looking at dollar CAD. I managed to grab a scalp on this one on that data. That ISM data came out and the dollar got sold off, which we all noted in the room was a pretty strange reaction, Kay, seeing that happen. So I nipped into a small scalp off this 136.50 on that dip, and it's been fortunate to carry on, though I've got out most of it around here, but I'm holding a little piece just to see what it does. But this one, again, you know, we're not trading Canadian fundamentals here. We're trading what's going on in the dollar, and the dollar at the moment is cleaning house, cleaning the levels. We're up through that trend line as well. So again, the ticks aren't counting for toffee. Didn't even blink at the 136.50 on the way back up. Hasn't blinked at any of the other levels. So sometimes you just got to not fight it. Sit back, see where it wants to go. Let the price action tell you where it's going to hit its head. 138, 38.10 is going to be a level. Then into 138.60s should we get up that far. Okay, you got anything on your radar?
Well, I've got plenty on my radar, as you know.
Yeah,
I always have plenty on my radar. I'm going to
let me hand it over because I just want to test
yeah,
my
sure,
thing.
mate.
Sharing screen. How's that?
Yeah, very nice.
Good. Brilliant. They moved the buttons on my Chrome machine.
Ah. Why would I do that? Why would they do that?
No, it's the usual. Oh, let's update it and change everything.
Right. This morning, so despite the dollar wrecking ball continuing to hit all currencies, the differentials haven't really widened with the euro specifically. And if you look at what's happening, the euro dollar stabilized at very low levels, of course, and the move is likely, I would say, not over yet because the dollar is very strong, but we will have very important jobs data out for the rest of the week, as I already said, plus the ISM. So we need to keep an eye on this one for further developments in the euro dollar. But stabilizing here has had a little bit of a result, and the result is that euro crosses are higher, which is quite, I wouldn't say amazing or really surprising, but it probably has to do with a bit with liquidity as well. Perhaps not as bad, not more bad data coming out of Euroland, perhaps. Or most of the bad numbers in there. So euro is now, after having done a fresh low, which is relatively important, by the way, is stabilizing, and euro crosses have taken over. So look at this euro dollar, and we are around those prior lows. There's also prior highs, prior lows in here, and then if you zoom in a little bit, this leg higher from the 106 up to the 112. If you look at the 127%, I know, I mean, I've got quite a few things one on top of each other. I should clean up my charts one of these days. It's at 104.63. Give and take a couple of pips. What's the low in euro dollar today? 104.60. So here we go. I think that's going to be a relatively important level here, this 104.60 as well. So this 60-80 zone on the euro dollar, I reckon is going to be important enough to monitor for the end of this day already, and even more importantly, over the next few days when those labor reports will come out in the US, because as we know, and as we've been repeatedly saying here, it's the jobs market is one of the very, very big dominoes that is still standing in the US, and that central bankers pride themselves and politicians pride themselves on saying that the US economy is doing very well. So that means that we have to watch it extremely carefully. We're seeing like really cracks appearing this week. We may be in for a bit of a dollar retracement, perhaps with yields lower. Until then, don't change a winning team. US yields higher. You look at even the long end. The long end is really pushing higher, and that has also, as a result, that the yield curve is inverting less and less. Now, if we would be in a positive yield curve, a yield curve that steepens is usually good for dollars, and we're seeing it in this market that even with an inverted yield curve, this less of an inversion, this bear steepening is already still having an effect as well on the dollar. And look where we are and this is a weekly picture, right? 484 here. That is 2010, the high after the global financial crisis, and the 30-year is pushing into that level right now. We're at 482, so that's another one that we are going to have to monitor, apart from the 10 years and then the difference between the yields and US yields versus the others. This is another one we need to monitor going further into this week, okay? If the long end holds up, it's usually pretty decent as well for dollar, okay? Now I want to go straight away into Ali's question about gold. So we've had this big breakdown, okay? Everybody knows there's been a very, very aggressive move last week of the month and last month, and we had the acceleration on Friday and then yesterday. Before I look at really the levels here, I want to say something about which could be seasonal effect or whatever. We know that over the past months and in the whole move up, and even those smaller move ups, we had news, whispers, rumors, or confirmation that China and their suit were regularly buying the metals, especially gold. They love gold, and we are in Golden Week, and I think the lack of Chinese buyers has something to do with this. And some market participants, well, I mean, people handling those flows basically must have been aware of it, and I think one of the reasons why gold and all the precious metals lost so much terrain is mainly due to the strong dollar, but also because of the lack of buyers and lack of people who are interested to continue to accumulate. So if you're trading gold, if you're trading metals, and there's not too much of a turnaround before the end of the week, have a look towards the end of the week where we are in gold, and then monitor very closely what happens next Monday when they come back online. Okay, that is something that I'm going to watch at least. In the meantime, Ali, you're short. We're trading around a bit of a level here. I'd say your really point of to monitor here is, look, this is the 50% here of this whole move that we had from September, November last year into May of this year, and we are below this 50%. So as long as we are below this 50%, I reckon that the techs are going to tell you that this still has room or will likely continue to be heavy. It's possible, it's very possible. Your next level is here, the prior lows, of course, around the 1805, and then your 61.8 of that move in the 1780s. I wouldn't even dare to imagine that this triangle would have some sort of a target, because that would take us all the way down into the 1600s. But let's do this one step at a time. I don't think that this is really reasonable to expect right now, but of course we never know. If those yields hit 5% in the 10s, this could really dump a lot further. But a few things to take into account there. So I reckon this 1841 stretchy to 1845, because that's another fib from before, may come into play. So 1445 is your resistance area on gold. Okay, that's what I think about it. And then you can look at this low 1805. But keep those US data in mind, because they may have an impact on and start to have an impact on yields, whether it's positive or negative, of course. Silver had this monster breakdown. I had some bids in here around 2060, and of course this market doesn't really like what I'm trying to do lately. I was trying to start to accumulate a little bit into this support zone with the low around 20.25, and trying to buy some for a bit of a jobbing activity, thinking we may have gone a little far too fast, but I unfortunately didn't get them. I'm still going to be very interested seeing where we are through all those reports that we see out of the US. I pulled my bid right now. I'm just going to watch it live, but I'm going to be interested here, and I'm for sure going to be interested if ever we start to get into this very, very big traffic zone here. And here I'm really looking to push to add to my long-term position, because I reckon in the end it's sooner or later going to turn around. But we have to be very, very, very careful with what we do right now, because it's going really very, very fast. Yeah, the dollar CAD is has finally broken this this resistance area. We tried a good few times. We never managed to break this trend line, but now we are. Okay, so this 137 is going to be your level to monitor on the close of virtually every day today, with oil in mind, energy in mind, oil, gas. And we have the double whammy at the end of the week, right? For the Canadian, do we have Canadian labor report as well on Friday?
Yes, mate.
All righty, so that's going to be perhaps a big level right into the end of this week on both US Canadian data and what's happening in the oil and gas world. Okay, so this is important enough. If you start to get back under 136.45.50, I think the party may be over, and then we're going to go lower again. But in the meantime, those levels that Ryan already mentioned before cannot be excluded, of course, if we continue to rally in the dollar CAD. As I was mentioning in the room this morning, it's a festival on some of those euro crosses. Euro Aussie, after this spike that we saw, spike lower that we saw towards the end of last week, is really ramping higher. And I already showed on the stabilizing differentials here that we have between the US and the EU. That may be one of the explanation. The other one is that, of course, commodities have been finding tops and trading a bit weaker. But we have to be careful what we do here with this Euro Aussie and some other Euro crosses. 166.5, prior high, prior low, prior low, prior low. Here we overshot a little bit, but 166, 40.50, 40.55, important zone, I think, on the Euro Aussie. All right. So Euro could just stabilize a bit more versus the dollar, but if the rest of those currencies get hammered, those euro crosses may do well. In the meantime, respect the level, okay, until we break. I was going to show something more. Yeah, just have a look at the S&P, okay? I think that's interesting. We're trying to perhaps my line is not. Yeah, it's pretty accurate. Pretty accurate, let's put it that way. We're trying to hold the channel, guys and girls. We're trying to hold this wider channel after the overshoot back inside. We're trying to hold this channel that we started to develop from October last year, and we are holding right now. So over the course of the week, watch what's happening. 42.35.50 on the S&P. A lot of people are talking about the 42 level, of course. I've got perhaps a tad below there, call it 41.90 figure. And then more people talking about a possible target of this whole move being into the 39s. But therefore, we're going to, and that's going to be the paradoxical move, I think. Reports on the job market that are taking the yields so much higher that the equities have to come off, and I'm probably going to have a problem with this move if it comes due to a very good labor market. Because if you have good economy, even with the yields rising, there may be a mechanical effect, an algo correlation effect for stocks trading lower. But I'm starting to think if this whole card house holds up in the US, but this algo or correlation driven market takes the stock market a bit lower, I'm going to start to be a bit interested here to counter trade it. For this to rally, we need numbers that are perhaps a little disappointing if you take it on the correlation side, but not too disappointing for it to become an economic crisis, because then I'll be looking at selling any rallies if we are really going in crisis mode in the US, because then to me the equity markets are not going to hold up. So again, in this one, very interesting zones we are on. Keep an eye on 43.30, 35, 43.50 on the top side. If that starts to go, that means that your channel is reinforced again, I reckon, and we can move a bit higher again. It's about it right now. You showed the dollar yen already, right? Next one is 150 and 150, 50, 75 on the dollar yen. And keep an eye on the speed. All the yen pairs have been correcting, but we are, hold on one second. But we are holding the range in the euro yen. Okay, so that's partially that euro thing as well that is going on. Oh yeah, one we need to keep a close eye on is Kiwi yen. Kiwi yen, we have this very long-term trend line I already showed last week, and it's been getting increasingly popular in the market. Blake already talked about it, other people mentioning it. We had a bit of a spike above, went up to even into the 90s, but then failed, and now we are starting to come off on this on this Kiwi yen. So it may be a fakey breaky, and this one we will see after the RBNZ where we are. I think RBNZ is going to keep their rates at 5.5%. They could be a bit more hawkish, but they're already at 5.5%. I don't think that they will really increase rates, and Kiwi is actually looking a bit weak right now. So yeah, keep an eye on this one. So it's going to be affected as well by the RBNZ, as well by the TEX, and as well by the MOF, of course, in Japan, whether to see if they let the party continue in dollar yen or not. And with that, I'm going to give it back to you, Ryan. I could show a lot more, but that's all right, I reckon.
Yeah, thanks, mate. I'm just going to grab it back quickly.
Hold on. I just want to show one last one, okay? Because I think you were mentioning about this SMB and the CPI. I do think the CPI is pretty comfortably within their range. And the month-on-month came down a little bit, and I still like, for as long as Euro Swiss stays above 95, 90 figure, I still like this. I know we are struggling with this trend line and the levels here, but that's because the market is still a bit afraid of the SMB. I do think, though, that SMB should be gradually less involved in actively in the Swiss franc right now. So I think for as long as we're above this 95, 90 figure, I kind of like Euro Swiss. Back over to you, mate.
Thank you, mate. Let me just grab it quickly. Because just something you said, and I think it's very apt for traders, you know, about cleaning up the charts and things. I often have duplicate charts, just ones where I keep a longer term picture on. And for that, dollar yen is a big one. Because one thing I like about dollar yen is when you get these big fib levels. I mean, these are, you know, decade long fib levels. Where did we have the 38.2 of this move? And I'm more interested in the yellow fib than the white one, but I'll keep it on there because there is a few years between the two moves here. But this has been, I've had this chart, or these levels up on charts for ages. It's 38.2, 152.71. Didn't quite get there, but when you're looking at this amount of time, it's you know, get up to 152 is fairly close enough. It is a level on its own. As you can see, there's a bit of prior history here going back into 87. So these big fibs are often worth just keeping an eye on, and we're obviously up near 150. We're very close to this fib as well. Got to do a lot of waiting. It can take a long while to get here, but you see that, and that would mark a significant double top if we do find a bit of trouble into that, and we hold it there. But back to Kay's point, yeah, you know, sometimes it's worth just opening up a fresh chart with nothing on it, and just picking your levels again, or taking an old chart and just clearing it all out. You know, sometimes there's certain levels that stick in your mind that you put straight back on. You know, 105 euro dollar, 114, 115 euro dollar, just off the top of my head. Big levels, big multi-year levels that you keep on your charts all the time. But having a refresh can do you the world of good. And something like TradingView is pretty good for that, because you can obviously open up, you know, multiple charts in the same pairings. Well, as a lot of platforms do as well, but it's quite easy to do in this one. And it just makes it easier to take a cleaner look at things, you know, like euro dollar, like cable. You can just get a bit of a wider picture on things, looking at the longer time frames to see what we're doing in the bigger picture. And if you wanted to, if you didn't know, I'll put a link in the chat as well, because if you don't use TradingView, if you take up an annual sub via that link there, you can get some free time to our ForexAnalytix platform. We've got an affiliate deal with those guys. So if you haven't been a customer before, you can look at that, and as well as getting a good price on the sub, you can come and spend some time with us in the chat room for a period. So check that out as well. Right. We'll call that a day, I think. Yes, I am premium at TradingView, and that link there, Ali, will get you. Well, there's various levels of subscription there for annual subscription. As I say, it's get you into the ForexAnalytix platform for a while. But yeah. Anyway, that's it for today. Keep an eye on that Jolts number. Jolts is a funny one. We're just looking to see if the trend is continuing. I don't think we're going to see any huge moves unless there's a real big variation. It's more just seeing if these openings continue to fall. Look at the quits and separations number within that Jolts number. The quits number is something I look at to see if people are happy to trade up jobs. You know, they feel confident about the jobs market. They'll look to get a better job, higher wages. If that number's coming down, that can suggest that people may be a little fearful of changing jobs at the moment because they're not too keen on the environment, which is, again, is a bit of a negative for the jobs market. And obviously, separations tells you people being let go and leaving. So that's what's important in those numbers. Anyway, have a great day, everybody. We shall see you all tomorrow for another show. Thank you very much. Cheers, Kay.